Hey there, welcome back to Great Quarter, guys. This is episode 66 for the Enterprise Fleet Summit. I'm your host, Andrew Cox, alongside Seth Holm. As always, this is the show where there are no lines between freight and finance. And today we have one of the best finance and freight minds in the game, really. It's Tom Wadewitz. He is a senior equity analyst at UBS Securities. He is one of the best on the street. He covers a multitude of subsegments within transportation. So we're going to get his thoughts on the market, maybe some of his favorite players, what are some of the trends that he's looking to take advantage of right now. So Tom, thank you so much for joining us and welcome to the Enterprise Fleet Summit.
Yeah, Andrew, Seth, thanks for having me. Pleasure to be with you.
So Tom, recently, I think it was just 3 or 4 weeks ago, you downgraded the trucking sector to neutral, but things have even gotten hotter since then. So I just wanted to know what were your reasons for why you downgraded the sector, and are you regretting it at all, given the speed and the volumes and everything else that's come in the last couple of weeks?
Well, my preference, of course, is to try to get the stocks right. So, we did what I call a soft downgrade, where we, have our earnings estimates went up a little bit. We raised our price targets a little bit. But I think the essence of the call was really that we thought valuation would be constrained. And I think investors post the 2018 cycle really had the mindset that the cyclicality is more entrenched. And so valuation would remain at kind of the low end on what's viewed as cyclical peak earnings. And so I think that it's an interesting mix where you have the truckload names trading at relatively low valuation and the fundamental backdrop is so strong. So, I think that one of the debates is how long the cycle will last. And if the market's willing to pay a bit more for an extended cycle, then that could provide some further lift to the stocks. So it's really around looking at prior cycles, looking at valuation. We are optimistic that truckload pricing will be strong this year, and that the fundamentals in 21 will continue to be good for the truckload carriers.
So Tom, you also, I believe, in that note, you took a look at the correlation between a couple of indicators, the market demand index from truckstop.com in relation to new Class 8 truck orders. Can you touch on that a little bit more and tell the viewers what you're seeing there?
Sure. So we looked at a number of metrics that a lot of times the intuition would be that if you look at earnings and get earnings right, then you get the stocks right. And I think that's true for a lot of transports. But for the truckload names, I think the market looks a little bit further forward and looks at some of these forward-looking metrics. The market demand index and the year-over-year change seems to show a good relationship with valuation for the truckload names. And so that's something we've looked at. I think we tried to look at a number of other metrics to say what's the relationship in terms of capacity metrics and also that spot market metrics. And so I think that was the case where we're saying, if year-over-year change in the market demand index is at a certain, when that tends to peak out, then valuation for the trucking stocks tends to peak out. And then we related MDI to some of the other key metrics. So looking at the, I think, year-over-year change in the BLS data for trucking company employment, and also looking at Class 8 tractor sales. So that's really the framework that we used in terms of looking at some of the forward-looking metrics that would really give you insight on what the stocks are going to do, but that are probably ahead of when contract pricing and when earnings are going to peak.
Right, that makes sense. And I think one thing that we talk a lot about at FreightWaves, and there's been a lot of articles in our wider media network, is, and I think you touched on it with the BLS employment data, but maybe you can expand on that. So, one debate that's sort of everywhere in trucking right now is that new Class 8 truck orders are booming. I think we hit 50,000 a month rate, which is 2.5 times replacement rate, and call it a 40-year high there for a couple months. The new trucks are coming down the pike, no question about it. Although there is a semiconductor shortage, which I think is beginning to impact even that. But the key question, Tom, is can these trucks even be seated? And you're seeing double-digit sort of wage raises at a lot of the sort of larger enterprise fleets. What's your opinion in terms of the actual driver pool moving forward through the rest of 2021 and in 2022?
So we think that the market will stay tight, and constrained drivers is a key factor on that, or the key factor in terms of capacity staying tight in 2021. I think that the reopening has potential. So vaccines and reopening of the economy has potential that some labor can get released into the market. So it seems possible that you could have an increase in driver count if you look forward kind of a ways beyond the vaccine. But even looking back to, let's say, cycles like 2004, 5, 6, when the housing market was very strong, there clearly is competition for truck drivers from other areas that are seeing cyclical strength and might strengthen further. So I think that there are also COVID-specific impacts on the capacity of driver schools that have been in effect. And so that would also relate to some of the vaccine rollout and the reopening of the economy, that you could have more capacity at the schools. So I think the way I would put it together is not to say I have tremendous visibility on it, but our base case is that the driver market stays pretty constrained, but you begin to see some relief from that, as the higher driver pay ultimately will attract more labor into the market. And there's probably some effect from the normalization, if you will, and the rollout of the vaccine. So we had looked at the base as well or the bottom in terms of the kind of April-May level. And we actually saw that there was a decent level of increase that seems somewhat normal in terms of the BLS data and drivers off that low level in May and April. So prior to February, when you had more of a weather impact, we did see what seemed to be maybe a normal level of return of drivers. But there are a lot of factors that could keep the market tight. We think as you go into 2022, you would see capacity come back in.
Yeah, that makes a lot of sense. I read Curtis Garrett from Recon Logistics. He had an interview with one of our writers where he said the customer acquisition cost to go out and get new customers has never been lower, but the driver acquisition costs have never been higher to try to bring on and seat new drivers. So with that in mind, a lot of cost adjusting right now for many of the sectors across transportation. And as we said at the top of the show, Tom, you cover a bunch of different sectors and subsectors of transportation. So let's dive into a couple of those subsectors. What are you most excited about? What are your favorite subsectors in your coverage area right now?
Right. So I think that if you don't mind if I take a step back and say kind of what's the overall view or some of the key things that inform our view on the stocks. And so, we certainly think that there's a lot of strength in freight, and that there's a lot of forward visibility to continued strength in freight. And so the industrial economy, there's a lot of disruption to the supply chain, a lot of pent-up demand. The retail and consumer economy inventory is still low, so that gives you good forward visibility to freight demand. And so then when we look at that, we think it's good across the different freight areas we cover. In terms of the pricing dynamic, the more cyclical areas like truckload and intermodal would be expected to get higher pricing this year. But we think pricing is good for everybody. One point of differentiation across the sectors would be volume growth. And so that's where part feeds into being a bit more cautious on truckload. We think it's just harder for the truckload carriers to add capacity and drive more miles and handle more loads. Where we do see room for volume growth, we think that LTL, intermodal, rail can see volume growth. So in addition to getting favorable pricing, we think the LTL industry can see strong tonnage growth. We think rail can see improvement in growth as well. Part of that's obviously easy comps. So some of the areas we like, less than truckload, rail, and I think those are pretty consensus for where the investor base is. A couple names that we like that are maybe more debated would be UPS and FedEx, where I think the debate is around they were COVID winners. And so you say, okay, do you want to own COVID winners, or do you want to own vaccine winners, if you will? And so I think that's an area where we have a positive view and buys on both UPS and FedEx, but there is more debate.
That makes sense. We're going to ask you that question. When it comes down to UPS, right? They just sold their LTL division to TFI International, which you cover. What's your impression of Carol Tomé? I think she's been on the job for a year. She sold that division, and she's been making some, sort of aggressive moves to improve the returns on capital at UPS. What do you make of her first year at UPS so far?
So we think that there is a great opportunity for Carol to have a really favorable impact at UPS, and I think that there's a portion of the investor base that shares that view that she will have a very positive impact in terms of I think it's a bunch of different dimensions, but it's doing things faster, making decisions faster, reducing bureaucracy, and then just a review that my assessment of UPS is they're a very efficient company historically and very efficient networks, but just to take a look at some of the underlying assumptions and review those in terms of how many service offerings a day do you need, things like that you can make changes to your assumptions, which can drive efficiency. So we're pretty optimistic about what Carol can do looking forward. I think assessing the first, almost a year is, it's like, positive so far, but the plans are really coming on June 9th when they do their analyst meeting. So I think we'll have a better sense of what does it really mean when we get to the analyst meeting on June 9th.
Hey, Tom, I'd like to jump back into LTL for a moment, because this is a discussion I've been having with Dennis Anderson, the sponsor of my newsletter at ArcBest, and we were just talking about LTL's place in the e-commerce world. We have a disbursement of endpoints. Not only are people willing to purchase much bigger and bulkier items online, we're seeing some of that demand spill over into LTL, and LTL kind of flexing its networks to be able to make some home deliveries. But we're also seeing brick and mortar expansion for the first time in 2021, more store openings than store closures for the first time in a long time, as we have some variables at play there. So just the question is, when you're looking at the LTL landscape, how do you best balance moving forward when we have this industrial recovery on its way, where there's probably some strong LTL volumes on the heavy side in the back half of the year, with also trying to take advantage of this e-commerce boom?
I haven't necessarily thought of it in that lens. I think I've tried to break it down into those two components, of maybe thought of it more as a combination of the two. So I don't know if I have a real granular answer for you. I think that some of the different companies are going to do better with balancing that and maybe tailoring the way they run their networks to attract more retail consumer freight or even e-commerce related freight. I think in terms of the way we're looking at it, we have a view that the industrial economy is going to be the primary driver for LTL freight activity. And as you have that strength in industrial economy, then you're going to see that growth in tonnage, and you'll see growth in, tons per shipment or pounds per shipment. And so you get not only the growth in shipments, but the favorable growth in mix. And that there's clearly strong leverage in the operating leverage in the LTL network. So I don't know that I have a real kind of granular view on how you necessarily finesse the balance between those two. But in 2021, I think the industrial side is going to be the bigger driver. And that's really more the kind of essence of our favorable view. We have buys on Old Dominion and XPO, and we have a neutral on Saia, but I think that, we think Saia has a lot of opportunity longer term for margin improvement as well. So it's a constructive view in general on LTL.
Great. So we have a few more minutes with you here. I want to cover so there was a blockbuster rail deal, probably the biggest in 10 years since Berkshire Hathaway bought BNSF and then acquired the whole company with Canadian Pacific acquired Kansas City Southern. Maybe we could just do a high level, Tom, what do you think of the deal? Do you like it? Does it have good strategic merit? And, what do you think of the price tag that CP is paying?
Right. So we think that the deal is pretty interesting, pretty favorable just in terms of the fit. And I think what we've seen historically is that railroads like to extend their reach. And I think there's a reasonable analogy to say CP is doing what CN did in the late 90s when they bought the Illinois Central and then bought the Wisconsin Central, and really drove value by extending their reach and providing more opportunity for growth and for efficiency gains as well. So I think CP has been running their network very well. They've had great growth the last couple of years. And so CP has a lot of operating momentum. And what I think generally the response is, this deal makes a lot of sense as an end-to-end deal to extend the reach for CP and provide opportunity for growth. We think that the price was a relatively high price if you compare it. You mentioned Burlington Northern and Berkshire Hathaway, and I think that deal was done at something like 9 or 10 times EBITDA, and this deal looks like more like a price of kind of 18 times. So it's a full, or it's a high price, but strategically the fit seems to make a lot of sense. So I think those are some of the initial thoughts. We've written about revenue synergies as well. I can get into that if you want, but I would just say that we think it's a deal that makes a lot of sense.
Yeah, let's get into that. Just a high level, whether you think the synergies that they've laid out, I think it's $800 million in revenue, and then translating to $780 million in EBITDA after including some cost cuts. How achievable do you think are those? And then I think you also, if I could tack on a second one, is there any other rails that are going to be negatively affected by this deal?
The revenue synergies, CP has not been precise about how much is truck conversion and how much is rail, whether you want to call it share gain or really shifting over some business from interchange partners. But our analysis, we published a pretty detailed note on this on Friday last week. And the analysis suggested that you can get, if I believe that CP is contemplating something like 25% share gain of business, which goes to interchanges with other railroads. So a prime example of that would be at Laredo, where Kansas City Southern has about 10% of their total revenue is revenue in Mexico that goes to Laredo and then is handed off the traffic to Union Pacific. And so with CP, you can take that traffic all the way to Chicago with the connection in Kansas City, whereas you can't do that with Kansas City Southern in the current form. And so we think that the intention for CP is to get something like 25%, 20 to 30% of the interchange revenue that Union Pacific would be capturing at that gateway, and some grain traffic with BN and UP, some crude traffic potentially that may run on CN, that there are interchange opportunities. When we translate that at about 25%, we got to about 530 million in revenue. And we think that's pretty high visibility revenue, that the assumptions are reasonable. There might be some more rail market share, and you might have additional, or you would have additional share gain from truck. So we think the revenue synergy target they have of about $800 million overall is quite reasonable. And we think that the disruption to other players, while significant for CP and KSU, is not large, given that Union Pacific, Burlington Northern, CN are large companies with large revenue bases. So we estimated, maybe 1.5–2% revenue at risk for a Union Pacific, as an example, from if that deal moves forward.
All right, so Tom, let's shift gears to the brokerage space just for a moment. Let's talk about where we are in the cycle. Where do you think we are in the cycle? How long till we have the next inflection point, or is the new cycle already underway?
So where are we in the cycle for brokerage? Is that, so I think of brokerage typically lagging a little bit with just the, asset-based truckload cycle. And, you typically have a period where the financial results you're affected by a squeeze when spot rates go up. I think this cycle that we've seen has been obviously driven by COVID with the big swings up and down. And so it's been an unusual cycle. But I think that if you look at the period in third quarter, spot rates were up week after week after week. And so brokers had a tough quarter and were squeezed. And then fourth quarter rates were more stable. And so you saw better brokerage results. So we think that the outlook for 2021 is very favorable for truck brokers in general, based on the idea that the market stays tight. So there's demand for spot activity. based on the idea that contract rates will go up a lot, based on the idea that strong growth in revenue per load, even if there is some gross margin percent pressure for brokers, that still will drive strong net revenue growth. And so we're pretty constructive on expected financial performance for brokers in 2021.
Do you have any preferred names in your coverage universe in the broker space, Tom?
So you've got kind of two pure play brokers, or maybe not pure play, but primary brokers with C.H. Robinson and Echo that we cover. We have a buy on CH, we have a neutral on Echo. I think both should benefit from the conditions I've described. I think that so C.H. Robinson would be preferred as the buy rated name. And I think that Robinson, because they have leverage to contract, is likely to see that step up that happened that some others benefited from in the fall a little bit later. So we're positive on Robinson on that pricing up in contract business. You do have a number of other players that brokerage has an effect on overall, even if it's not primary. So names so JB Hunt, Schneider, Knight, some others. I think in that group, I would say that XPO, our positive thesis is leverage to LTL, which is a strong market, leverage to truck brokerage, which is a strong market, and those feed into our buy rating and our positive view on XPO.
All right. Thank you, Tom. That's great stuff. Great insights. We've got a big year for brokerage ahead, according to Tom Wadewitz. Tom, thank you so much for taking the time out of your day.
Great. Yeah, Andrew, Seth, thanks for inviting me. Enjoyed the conversation.
Yeah, obviously. We'll have you back again soon.
I look forward to it. Have a great day.
You as well,
Thanks.
sir.
You too.
All right, that's been episode 66 of Great Quarter Guys, the show where the lines between freight and finance are none. We've got a lot in store for you throughout the day here at the Enterprise Fleet Summit, so don't go anywhere. We'll see you next time.